So we are going to now be doing some adjusting entries. And the purpose of adjusting entries, just as a quick refresher, being that at the end of a period on usually December 31st, but it could be quarterly, that you need your financial statements to reflect the current state of the business. So oftentimes there's a bunch of expenses, like some partially completed work or some expenses which haven't been registered yet in the journals. And this is your opportunity before you complete an income statement or before you complete your balance sheet for the year to make sure that everything is up to date. So that's the entire point of adjusting entries. And that being said, we have our first adjusting entry, 3 months having passed since the annual insurance premium was paid. We had annual insurance originally purchased for $14.40. So in this case, when we did the original transaction for the insurance, we would have did insurance prepayment as our debit and cash as our credit, but we didn't use all that insurance immediately. We've just prepaid for it. Now we've used 3 months of it. It's gone. So now we need to adjust for it. We have Q2. So we have an insurance expense and I'm just going to math that out below. We have 3 months of it having been used. So 3 divided by 12.
$360.
Thank you. I'm just going to write it down here. And that is for, as you mentioned, 360. We are going to credit prepaid insurance. Again, we've already paid for this.
Are you using the right sheet?
Sorry?
Are you using the right sheet?
Yeah, so these are journal entries, this sheet here.
What are these ones for again?
That should be for balance sheets or income statements. Are there any questions about this one here? Why we did things the way we did?
Can you go through it? Just one.
Sorry?
Can you just go through it one?
Yeah, I just mentioned here because 3 months ago, we paid for an entire year's worth of insurance, but we hadn't used it yet. So now we've used 3 months of insurance, so now we record those 3 months as an expense. So an expense or a revenue is only an expense or a revenue when they actually happen. So it's just like if you prepay somebody for work and they haven't done the work yet, it hasn't happened yet. So December 31st, we have Donald G hasn't been paid for work. So we owe Mr. G some money here, but we haven't paid him yet. So what we're going to do is wages expense. And we are going to credit wages payable.
For 2,450.
I'm just going to write that down here, 345 times 7. And how much did that come to?
2,450.
2,415, thank you. Okay. We now have the next question. The office equipment's being expected to have a 5-year life of $2,000. residual value, and we initially purchased it 5 months ago for $10,000. Just a quick question for all of you, because I'm not sure how Evan wants you to do this. Does he use the half-year rule, or does he want you to go to the specific month?
We do it by month.
You do it by month. Okay. There is an alternative rule. I'm just making sure that I give you guys the correct information for your midterm. So we bought it 5 months ago for $10,000. Let's start doing some math here. When we have depreciation, again, depreciation isn't the cash expense, but we have to account for the fact that our stuff declines in value over time, like when we buy a new car, and we are expecting to be able to resell it for $2,000. I assume he wants you to do the straight line method. I think that's the only method that you do in accounting 150. So over 5 years, you have $8,000 is going to depreciate. That's just the $10,000 that you bought it for minus the $2,000 that you can probably sell it for at the end. So $8,000 that you can depreciate, and 8,000 divided by 5 years. Sorry, what was that? 1,600?
I think then you're going to divide it by 12.
Then I'm going to multiply that by 5 over 12. I'm going to do a shortcut here. So every year we have, I'm just going to quickly circle this here. We have, that's our annual depreciation. So every year, that furniture loses $1,600 worth of value. We're all good to this point? So, sorry?
Oh, no, go ahead.
Okay, so now we only bought this 5 months ago for $10,000. So we only have 5 months of the year. We haven't done the full year depreciation. We can't claim that full $1,600. So we're gonna do $1,600 times 5 over 12 to reflect the partial year. And that should come to $667, meaning that we've only done $667 worth of value lost. Is that calculation clear? So we have our depreciation expense. And that is for $667. And we have our special account called our accumulated depreciation. What's it for? Thank you. Office. I'm going to shorten it there. That says office equipment. I know it's hard to see. And that's also for $667. Okay. Any questions, concerns about that one? Okay. So December 31st, again, we prepaid rent for 2 of the 3 months. Sorry, this question has a spelling mistake. We prepaid rent for 2 of the 3 months and that have expired. Okay. I'm just going to rewrite this here. Prepaid rent 3 months. Used 2. That's how I'm going to write that. We initially paid, I assume that's $600 for, no, that must be $6,000 because paying $200 a month doesn't make sense. I hope that's not reflected because clearly there's some mistake here in the question. Let me just double check that it's not going to affect our trial balance. No, I don't think it will. I think Evan made that separate for us, so. Okay, we're gonna assume that he paid $6,000 for 3 months rent,
Okay, so that's,
and he used 2 of it. Sorry, guys.
yeah.
That's just hard to read.
Just one question, what would you write for the depreciation, the end of it,
Sorry?
on the third line?
The annualized depreciation?
Oh, is that what it is?
Yeah, I just said the $1,600 that I wrote down here. That's the annual depreciation. That's how much annually it is. But we've only did 5 months of the year.
So that's how it ended up there? I just,
Yeah, so if we were to have bought this equipment on January 1st, we'd be recording $1,600.
okay.
But we didn't buy it on January 1st. We bought it on sometime, I think in August or July. I didn't count it. I would finger count it. So we have our prepaid rent. We have a rent expense now. We've used part of the rent that we've prepaid. And that rent, $6,000 for 3 months, having used 2 of it, that means it's $4,000 that we've used. And we're crediting the prepaid rent account because, well, now we only have 1 month left over. Should be $2,000 left in that account. Okay. The next question, I'd like to just give everybody 30 seconds to try for themselves here. The computer equipment is expected to have a 4-year life with no residual value or no resale value. And was purchased 3 months ago for $3,040. So just give it 30 seconds. We're just doing exactly what we did right up here all over again.
Take your time.
I see people discussing their answers, so I'll give you another second or two.
fancy shirts from?
Oh, my fancy shirts? I don't know. I just see shirts and I I buy them. I like this one with lobsters.
760.
All right. Can somebody let me know what 3,040 divided by 4 is?
It's 760.
760. Thank you. So that's our annualized rate. What's 760 multiplied by 3 over 12? 190. Thank you. All right. Any concerns with that one? All right, we're all looking good here. So the last one, December 31st, we have inventory of computer supplies is $780. Current balance, meaning before we make the adjusting entry, the balance is $2,135. We have here, should be a supplies expense.
Yeah. Supplies inventory.
Let me make this in red, supplies expense. And we're going to be crediting supplies. I'm not sure if he calls the account supplies inventory, but I will defer to you. Supplies inventory. And that difference is 2,135 subtract 780,
1,355.
1,355. And just to clarify for the folks that aren't quite sure what happened there, at regular intervals, a business will say, like with things like your office supplies or any supplies really, that they don't keep track as they go. Instead, they just do a count at regular intervals, like let's say every 3 months or every year, and then say, when we had all this stuff, the stuff what we bought is worth $3,000, and now we've used $1,000 worth of that. So now we have to make that an expense at the end of account. So they would have just done an account here and said, now we only have $780 left, so we better make an expense to make up for that. That's all they did. Does that make sense? Okay. Any questions about that? Let's take another 5 minutes, and then we'll come back to the next question.